When the world gets scared, one asset often starts flashing a warning signal. Gold. It does not produce cash flow. It does not pay dividends. It does not run a business. And yet, when markets become nervous, investors, central banks, and ordinary people still turn toward it. That is the strange power of gold. Gold rises when people lose confidence in paper promises, currencies, bonds, banks, governments, or even the stability of the global system itself. And right now, gold is not rising because of one single event. It is rising because multiple fears are arriving at the same time. War risk, inflation risk, debt risk, currency risk, and the fear that the world may be entering a less predictable economic era. But here's the important question. If gold is supposed to be an old asset, why is it suddenly acting like one of the most important signals in modern finance? Gold is often called a safe haven asset. That simply means investors tend to buy it when they want protection from uncertainty. But the phrase safe haven can sound too simple. Gold is really a trust barometer. When trust in the system is high, investors often prefer assets that generate income: stocks, bonds, real estate, business investment. But when trust starts to weaken, gold becomes more attractive because it is not someone else's liability. A bank deposit depends on the bank. A bond depends on the borrower. A currency depends on the government, and central bank behind it. Gold is different. It does not need a promise from anyone to exist. That is why gold often becomes more appealing during geopolitical shocks, financial stress, inflation scares, or periods of currency weakness. It is not magic. It is psychology, history, and risk management working together. One of the biggest reasons gold matters today is that central banks are buying it. Central banks manage national reserves. They usually hold assets like dollars, euros, government bonds, and gold. When central banks buy gold, they are not chasing a short-term internet trend. They are managing long-term national risk. This tells us something important. Central banks want diversification. They do not want all their reserves tied to one currency, one government bond market, or one financial system. Gold offers a form of insurance. It is not controlled by a single country. It cannot be printed. And it has thousands of years of history as a store of value. So when central banks buy gold, the message is not gold is shiny. The message is, we want protection if the system becomes less stable. Gold's price is also shaped by interest rates. This part is crucial. Gold does not pay interest. If you hold gold, you do not receive a coupon like a bond or a dividend like a stock. So when interest rates are high, gold can look less attractive because investors can earn income elsewhere. But the key is not just interest rates. It is real yields, the return investors earn after inflation. When real yields fall, or when investors believe central banks may cut rates, the opportunity cost of holding gold falls too. That can support gold prices. This is why gold can rise during periods when investors expect weaker growth, lower future rates, or inflation that remains difficult to control. Gold is not only reacting to fear, it is reacting to the price of protection. When geopolitical risk rises, investors often ask one question: what survives uncertainty? Stocks can fall if profits are hit. Bonds can be pressured if inflation rises. Currencies can weaken if governments borrow too much or lose credibility. Gold does not solve these problems, but it can sit outside them. That is why gold can rise during wars, banking fears, debt concerns, and currency instability. That tells us the market is not treating gold's rise as a random spike. It is treating gold as a structural response to a more uncertain world. But there is one mistake many people make. They think gold rises only because people panic. In reality, gold often rises because serious institutions are preparing. Gold is powerful, but it is not perfect. It can fall sharply. It can move against expectations. It does not generate income. And if investors suddenly regain confidence in the economy, gold can lose momentum. Jewelry demand can also weaken when prices get too high. So gold is not a guaranteed win. It is better understood as insurance. And insurance usually becomes more expensive when people believe risk is rising. That is exactly what gold's rally is telling us. The world is not simply buying metal, it is buying protection. Gold rises when the world gets scared because gold represents something rare in modern finance. An asset without a central bank, without a CEO, and without a government promise behind it. When confidence is strong, that may not matter. But when confidence weakens, it matters a lot. Gold is rising because investors are looking at the world and seeing more risk. Geopolitical tension, inflation uncertainty, debt pressure, currency concerns, and a financial system that feels more fragile than it used to. The key lesson is simple. Gold is not just a price on a screen. It is a signal. And right now, that signal is telling us that the world is not calm. It is hedging. If you want to understand the hidden forces behind markets, money, and global risk, subscribe the channel. More stories like this are coming next.